The investor who made billions predicting the 2008 collapse just shut down his hedge fund. On November 10th, 2025, Michael Burry's Scion Asset Management officially terminated its SEC registration. This isn't just another fund closure. This is the man who saw through the subprime mortgage scam when everyone else was buying, who made personal profits over $100 million while banks collapsed around him, walking away from the game entirely. Here's what should grab our attention. Burry told his investors on October 27th that his estimation of value in securities is not now, and has not been for some time, in sync with the markets. Think about what that means. The guy who correctly predicted the biggest financial crisis in our lifetime is saying the math doesn't work anymore. But here's where it gets really interesting. Burry's last 13F filing from the third quarter of 2025 reveals something extraordinary. He was holding $912 million in put options against Palantir and $186 million in puts against NVIDIA. Massive bets that these AI darlings are going to crash. These aren't short-term trades either. His positions extend all the way to 2026 and 2027, suggesting he believes this correction will be massive and prolonged. You want to know how confident Burry is in his thesis? He's publicly claimed that tech companies are fudging depreciation schedules on their AI infrastructure to artificially inflate earnings. That's not market commentary. That's an accusation of systematic accounting manipulation across the entire tech sector. When someone with Burry's track record makes claims like that, you don't ignore them. Now, here's what makes this move unprecedented. Burry is converting to a family office structure, which means no more public reporting requirements. After November, we won't see his positions anymore. He's going dark right when the markets are hitting all-time highs. On his Twitter account, he dropped one final hint before going silent. On to much better things, November 25th. This is only the second time in Burry's career that he's voluntarily closed his fund while markets were still rising. The first time was 2008, right before the financial system nearly collapsed. Back then, he made his legendary bet against subprime mortgages while everyone called him crazy. His fund returned 489% in 2007. He pocketed over $100 million personally, then closed shop just as the housing market reached its peak. Think about the irony here. While the S&P 500 hovers near record levels and AI stocks continue their seemingly unstoppable climb, the man who called the last major crash is saying it's become impossible to profit in these markets. That's not a comment about his skill. That's a comment about the markets themselves. What we're witnessing is a master chess player walking away from the board, not because he's losing, but because he realizes the game has fundamentally changed. When someone who made billions by seeing through financial illusions tells you that reality and market prices have completely disconnected, that's not just investment advice. That's a warning about the entire system. The question every American investor should be asking themselves right now is simple. If Michael Burry can't make money in these markets, what does that tell us about what's coming next? Here's what most investors don't realize. Legendary fund managers closing shop during market highs isn't just coincidence. It's been the most reliable crash indicator in American financial history. Every single time a master investor has walked away saying, "The math doesn't work anymore," a devastating collapse has followed within 18 months. Let's start with the grandfather of them all, Jesse Livermore in 1929. Livermore was the greatest trader of his era, the man who made $3 million shorting the 1907 panic, when $3 million could buy you half of Manhattan. By September 1929, while everyone else was celebrating the Roaring Twenties, Livermore quietly closed all his long positions and started betting against the market. His associates thought he'd lost his mind. The Dow had tripled since 1924. Everyone was getting rich. But Livermore told anyone who would listen that the market had become artificial and was doomed to collapse. He wasn't making emotional predictions. He was reading the mathematical impossibility of stock prices that had completely divorced themselves from company earnings. October 24th, 1929, the market crashed. By 1932, it had fallen 89% from its peak. Livermore made $100 million shorting the collapse, equivalent to about $1.5 billion in today's money. While millions of Americans lost everything, the man who recognized the pattern early walked away with generational wealth. Fast forward to March 2000, and we see the exact same pattern playing out. Julian Robertson, who ran Tiger Management, had generated 31% annual returns for 20 years, one of the greatest track records in Wall Street history. His fund managed $6 billion, and institutional investors fought for allocation spots. But in March 2000, Robertson shocked the financial world by shutting down Tiger Management entirely. His letter to investors was brutal in its honesty. The current technology, internet, and telecom craze bears no resemblance to rational investing. He couldn't compete with dot-com mania because he refused to abandon fundamental analysis for speculation. The financial media destroyed him. CNBC called him a dinosaur who couldn't adapt to the new economy. Tech executives mocked his old-fashioned thinking. Investors pulled billions from value funds to chase internet stocks that had no revenue, let alone profits. 1 month later, the Nasdaq peaked at 5,048. By October 2002, it had crashed to 1,114, a 78% collapse that wiped out $5 trillion in market value. Companies like Pets.com, which had spent millions on Super Bowl commercials, went bankrupt. The new economy that was supposed to change everything proved to be built on nothing but marketing and hope. Robertson was right, but he was exactly 1 month early. In markets driven by momentum instead of math, being early and being wrong look identical until reality finally asserts itself. Now, let's talk about Michael Burry's first rodeo. From 2005 to 2006, while housing prices soared and banks handed out ninja loans like candy, Burry was quietly buying credit default swaps on subprime mortgage securities. His investors revolted. They tried to pull their money out, claiming he'd lost his analytical edge. The financial establishment treated him like a pariah. Bank executives called him delusional. Real estate agents insisted housing never goes down. Government officials assured Americans that subprime lending was expanding homeownership opportunity. Even his own investors sued him to get their money back, but Burry had done the math. He'd read the mortgage documents, analyzed the loan quality, and realized the entire housing market was built on fraudulent lending practices. In 2007, his fund returned 489%. He personally made over $100 million. Then he closed Scion Asset Management while banks were still pretending everything was fine. 6 months later, Lehman Brothers collapsed and our entire financial system nearly imploded with it. The man everyone called crazy had been the only one telling the truth. This pattern extends beyond individual investors to institutional fund managers as well. David Einhorn of Greenlight Capital, who made billions shorting Lehman Brothers before its collapse, spent 2020 and 2021 warning about meme stock mania and Fed-induced market distortion. While GameStop and AMC soared on Reddit hype, Einhorn insisted markets had become detached from fundamentals. Seth Klarman, who manages the $30 billion Baupost Group and is considered one of the most conservative investors alive, actually returned capital to investors in 2020. His reason? The current market environment is one of the most challenging in 40 years of investing. Markets rallied another 50% after his warning, but the underlying fragility he identified never disappeared. Here's the mechanism that drives this pattern. When legendary value investors can't find profitable opportunities, it signals that prices have completely disconnected from underlying economic reality. Markets operate on two forces, fundamentals and momentum. When momentum dominates completely, the smartest money recognizes that mathematical analysis becomes useless and exits the game entirely. Every crash begins the same way. Asset prices rise beyond any reasonable valuation. Smart money starts selling, while dumb money keeps buying. Eventually, the gap between price and value becomes so extreme that even minimal selling pressure triggers a cascade of forced liquidations. The tragedy is that retail investors never see it coming. They're always the last to buy at the top and the first to panic at the bottom. When Livermore warned about 1929, individual investors ignored him and lost everything. When Robertson warned about 2000, day traders mocked him and got wiped out. When Burry warned about 2008, homeowners called him unpatriotic and lost their houses. The pattern is about to repeat itself. Michael Burry is closing his fund for the second time in his career, using almost identical language to describe market conditions. The only difference is the asset class driving the bubble. In 2007, it was housing. In 2025, it's artificial intelligence. But the underlying mechanism remains exactly the same. Easy money from the Federal Reserve creates artificial demand. Prices disconnect from reality, and the smartest investors recognize the mathematical impossibility of the situation and walk away. What comes next has played out before, and it's never been pretty for the people who didn't listen. So, why does Michael Burry believe 2025 looks exactly like 2007? The answer lies in his massive bearish positions, and a thesis that should terrify anyone holding AI stocks in their 401k. Burry's $912 million put position against Palantir isn't a short-term trade. It's a declaration of war against the entire artificial intelligence bubble. He's betting that Palantir, currently trading at over 300 times earnings compared to a historical market average of 15 to 20, represents the same kind of mathematical impossibility that subprime mortgages did in 2007. Think about what a 300 price-to-earnings ratio actually means. You're paying $300 for every $1 of annual profit the company generates. At that rate, it would take 3 centuries for your investment to pay for itself through earnings alone. That's not investing. That's speculation built on pure hope that someone else will pay an even more ridiculous price tomorrow. But Palantir is just the beginning. Burry's $186 million bet against NVIDIA extends all the way to 2027, suggesting he believes the entire AI chip revolution is built on the same kind of accounting manipulation and easy money that fueled the housing bubble. NVIDIA's market capitalization has reached $3 trillion, larger than the entire stock market of the United Kingdom. Here's where Burry's accusation gets really serious. He claims tech companies are fudging depreciation schedules on their AI server infrastructure to artificially inflate current earnings. Translation: companies are spending billions on computer hardware, but spreading those costs over unrealistically long time periods to make their quarterly profits look better than they actually are. If Burry is right, this means the earnings that justify these astronomical stock prices are essentially fraudulent, just like the mortgage securities that appeared safe in 2007, because nobody looked at the actual loan quality underneath. The parallels to previous bubbles are impossible to ignore. In 2000, companies with no revenue traded for billions because investors believed the internet changes everything. In 2007, housing prices doubled in 5 years because real estate never goes down. In 2025, AI companies lose money hand over fist while their stock prices soar because artificial intelligence is the future. The narrative is always the same. This time is different. But the math never lies, and the math right now is screaming danger. Consider the broader market conditions that enabled this bubble. Just like in 2005 to 2007, the Federal Reserve has flooded the system with cheap money, creating the same easy credit environment that fueled the housing mania. When borrowing costs nothing, investors chase any asset that promises higher returns, regardless of underlying value. The Magnificent Seven tech stocks, Apple, Microsoft, Google, Amazon, Tesla, Meta, and NVIDIA, now have a combined market capitalization exceeding $15 trillion. That's larger than the entire economies of China or the European Union. 7 companies are supposedly worth more than the economic output of billions of people. Pop quiz: does that sound sustainable to you? Here's what happens when bubbles burst and who wins versus who loses. The insiders always exit first. Company executives exercise their stock options and sell while retail investors keep buying. Venture capital firms cash out their stakes while pension funds load up on growth opportunities. By the time ordinary Americans realize what's happening, the smart money has already moved to safety. The winners in the coming crash will be the same people who won in 2008, those who recognized the pattern early and positioned themselves defensively. Cash, gold, treasury bonds, and yes, put options against overvalued tech stocks. These become the life rafts when the bubble finally pops. The losers will be the same people who always lose. Retail investors holding AI stocks at their peak, pension funds overexposed to tech growth, and anyone who believed this time is different despite centuries of evidence to the contrary. But here's what should concern every American most of all. Unlike previous bubbles that were concentrated in single sectors, this AI mania has infected the entire market. Your retirement account, your pension fund, your college savings plan, they're all loaded with these overvalued tech stocks because fund managers have no choice but to chase performance while the bubble inflates. When Burry made $100 million in 2008, it was because he recognized the mathematical impossibility of the situation before anyone else and had the courage to act on his analysis. He's telling us the exact same thing in 2025. Markets have become detached from reality, making rational profit impossible. In 1929, Jesse Livermore warned that stocks had become artificial and were doomed to collapse. Most investors ignored him and lost everything. In 2000, Julian Robertson warned that tech valuations bore no resemblance to rational investing. Most investors ignored him and lost everything. In 2008, Michael Burry warned that housing finance had become fraudulent. Most investors ignored him and lost everything. Today, Michael Burry is closing his fund and walking away from markets he describes as impossible to navigate rationally. History doesn't repeat exactly, but it sure does rhyme. The pattern is always the same. Brilliant investors recognize unsustainable conditions, warn about mathematical impossibilities, get ignored by the crowd, then get proven right when reality finally reasserts itself. The man who called 2008 is calling 2025. The only question that matters is whether you'll listen this time, or if you'll join the long list of investors who learned too late that when legends like Michael Burry walk away, they're not abandoning opportunity, they're avoiding disaster.